Forget the margin hikes, forget the COMEX games, forget the $60 paper price for just one moment. While Wall Street was busy rigging the casino last night, something happened in Seoul, South Korea, that makes the banking manipulation look like a rounding error. Ladies and gentlemen, Asian guy here, we have received confirmation, technical confirmation, of a technology that doesn't just change the electric vehicle market, it changes the periodic table of commodities. For 10 years, the bears have told you, silver is just a byproduct. Silver is plentiful. Silver is dead. They told you that industry was moving away from silver. They told you that thrifting in solar panels would kill the demand. They were wrong. They were dangerously, catastrophically wrong. What I am about to show you is the silver bomb. It is a single technological breakthrough that is mathematically guaranteed to consume the entire global mine supply of silver within 3 years. We are talking about the Samsung solid-state battery. We are talking about a 9-minute charge time. And we are talking about a number that the bullion banks are terrified of, 1 kilogram. That is how much physical silver is required for every single car. If you thought the solar squeeze was big, you have no idea what is coming. Solar was the appetizer. This is the main course, and the table is empty. Let's strip away the marketing fluff. Samsung SDI has been teasing solid state for years. Everyone has. Toyota, QuantumScape, Panasonic. It became a buzzword. But as of late 2025, Samsung has done something the others haven't. They confirmed mass production for 2027. This isn't a lab experiment anymore. This is a factory build-out. Why is this specific battery different? Because of the anode. In a traditional lithium-ion battery, the one in your phone, the one in a 2024 Tesla, the anode is made of graphite or silicon. It works, but it has limits. It expands. It degrades. It charges slowly because the lithium ions have to physically intercalate, wiggle, into the graphite structure. Samsung threw the graphite out. They replaced it with a silver-carbon, Ag-C composite layer. Why silver? Because silver is the most conductive metal on Earth. But more importantly, in this specific chemical reaction, silver has a unique property. It creates a solid solution with lithium. When you charge this battery, the lithium ions rush through this solid electrolyte. They hit this silver-carbon layer. The silver acts as a landing pad. It dissolves the lithium instantly, creating a smooth, flat layer of lithium metal. It prevents dendrites. Dendrites are the enemy. They are the jagged metal spikes that grow inside batteries and cause them to explode. The silver layer stops them. It creates a perfect, uniform distribution of energy. This allows 3 things that were previously impossible. Energy density, 500 watt-hours per kilogram. That is double the density of a current Tesla battery. It means the battery is half the size and half the weight. Range, 600 miles, 966 kilometers on a single charge. That kills range anxiety forever. Speed, and this is the game changer. A full charge in 9 minutes. Think about that. You pull into a station, you plug in, you go buy a coffee, you come out, you're full. It is the same experience as pumping gas. This removes the final barrier to EV adoption. But physics has a price, and the price is silver. Now, I need you to follow me on the math, because this is the math that JP Morgan is trying to hide from you. The Samsung Ag-C anode layer is incredibly thin, about 5 micrometers. Critics say, oh, it's thin, I can't use that much silver. No, wrong. Surface area is massive. An EV battery isn't one big block. It is thousands of sheets folded and wound together. The surface area of the anode in a 100 kilowatt battery pack is roughly the size of 2 football fields. To coat that surface area, even with a 5-micron layer, requires a significant amount of material. The scientific papers, specifically the Nature Energy publication that this tech is based on, detail the loading requirements. It comes out to approximately 5 grams of silver per ampere hour, AA. Let's scale that up to a vehicle. A standard premium EV battery is 100 kiloma, based on the voltage and capacity configurations Samsung is using. The math resolves to approximately 1,000 grams of silver per vehicle. 1 kilogram, 32, 15 troy ounces. Look at this bar. This is what goes into every single car. Currently, a Tesla Model Y uses maybe 20 to 30 grams of silver, mostly in the circuit boards, the contacts, the switches. Samsung just increased the silver load per vehicle by 3,000%. Do you understand what this does to the supply-demand charts? It breaks them, it snaps the line in half. Let's run the adoption scenarios. Global EV production is projected to reach 30 million units per year by the late 2020s. Scenario A, the niche product, 10% adoption. Let's say only the super rich buy these cars, only the BMW 7 Series and the Audi A8, 3 million cars, x 1 kilo silver, or 3,000 metric tons. That is 96 million ounces. That is 12% of the entire global mine supply, just for the high-end luxury market. Scenario B, the mainstream shift, 20% adoption. Samsung partners with Stellantis, GM, and Ford. 6 million cars, x 1 kilo silver, to over 6,000 metric tons. That is 192 million ounces. We are now talking about consuming 25% of all the silver mined on Earth. Scenario C, the standard, 50% adoption. This is where the math becomes impossible. If 15 million cars use this tech, that is 480 million ounces of silver. That is 60% of global mine supply. We only mine 850 million ounces a year. Solar panels already eat 200 million. Electronics eat 300 million. Jewelry eats 200 million. Investment eats 250 million. We are already in a deficit of 200 million ounces a year. Where are we going to find another 480 million ounces for Samsung? It doesn't exist. There is no stockpile big enough. There's no mine big enough. So what happens? The price has to rise to a level that destroys other demand. Jewelry has to stop. Investment has to stop. Solar has to bid higher. The car companies, Samsung, BMW, Toyota, have the deepest pockets in the room. If Samsung needs silver to build a $100,000 car, they will pay $200 an ounce for it. Because $200 an ounce times 32 ounces is $6,400. In a $100,000 car, a $6,400 battery cost is painful. But it is possible. For you, buying a Silver Eagle at $200 is hard. For Samsung, it is a cost of doing business. They will outbid you. They will outbid the mints. They will outbid the jewelers. They will suck every available ounce of silver into the automotive supply chain. I don't think this is just Samsung talking a big game. They have buyers. We have seen this reports on the partnership with BMW. BMW is launching the Neue Klasse new class vehicles in 2027. They have publicly stated they are moving to solid-state batteries. Samsung SDI is their partner. Rumors suggest BMW has already pre-ordered 500,000 units for the 2027-2028 model years. Let's do that math. 500,000 cars, 1 kilo per car, 500 metric tons of silver, that is 16 million ounces. That is just one car company for one model line, effectively removing 16 million ounces from the COMEX before the year even starts. And here is the force majeure connection. How does BMW guarantee that silver? They don't buy futures contracts. They don't buy SLV. They sign offtake agreements directly with the miners. They go to Fresnillo. They go to KGHM. They go to Glencore. And they say, we will buy your next 5 years of production. Here is the cash. This is why the COMEX inventory is frozen. This is why the registered stocks are draining. The metal is bypassing the exchange entirely. It is going from the mine directly to the Samsung factory in Hungary. The public market, the one you trade on, the one where you see the price, is becoming a market of scraps. The main course has already been eaten by the industrial giants. But wait, it gets worse. Because while Samsung is targeting 2027, China is targeting now. BYD, build your dreams. The biggest EV maker in the world. They just unveiled their 5-minute charging infrastructure. Do you think they are achieving 5-minute charging with old-school graphite anodes? Physics says no. We have intelligence from the Shenzhen tech sector that BYD is testing a hybrid solid battery. It uses less silver than Samsung, maybe 500 grams instead of 1,000 grams, but they are deploying it faster and in higher volume. BYD sold 3 million EVs in 2024. If they convert just 30% of their fleet to this new silver-heavy tech to compete with Samsung, 1 million cars x 500 grams, now 500 metric tons, another 16 million ounces. And that is just the start. If BYD puts this in every car, 3 million cars x 500 grams, and 48 million ounces. Between BMW and BYD, we have just accounted for nearly 100 million ounces of new demand. That wipes out the entire global surplus of the last decade. Gone. And we haven't even talked about Tesla yet. The car business is a game of follow the leader. If Samsung, partnered with BMW, releases a car that charges in 9 minutes, do you think Elon Musk is going to sit back and sell a Tesla that takes 30 minutes to charge? Do you think Mercedes is going to let BMW steal the entire luxury market? Absolutely not. They have to match the spec. And to match the spec, they have to match the chemistry. This brings us to the Tesla panic that is unfolding right now in the mountains of Peru. For the last 5 years, Tesla has been betting the farm on the 4680 battery. It was supposed to be cheaper, faster, better, but it has a fatal flaw. It uses a graphite anode. It is physically incapable of 9-minute charging without overheating. When the Samsung specs leaked in late 2024, we received reports that the mood inside Tesla HQ shifted from confidence to crisis. Elon Musk knows that speed is the new horsepower. So what did they do? They sent their battery partner, Panasonic, on a shopping spree. We have intelligence, backed by recent local reports in Lima, that Panasonic executives have been in Peru since November 2025. They aren't there for tourism. They are there to lock up silver supply. Peru is the world's third largest silver producer. But unlike Mexico, where the mines are largely controlled by established players like Fresnillo, Peru has a more fragmented market. Panasonic is reportedly negotiating mine-to-factory offtake agreements. They are bypassing the refiners. They are bypassing the COMEX. They are trying to buy the ore directly from the ground. Why? Because Panasonic is pivoting. Search results from September 2025 confirm that Panasonic is rushing to develop a new generation battery for 2027. They call it anode-free or high capacity. But look at the specs they are targeting: 900 kilometer range, faster charging. You cannot get there with graphite. You get there with silver. Whether they use the full Samsung method, or a hybrid method to 500 drain, the reality is the same. Tesla is entering the silver market. If Tesla produces 2 million cars a year, and they put just 500 grams of silver in each one, that is 32 million ounces of new demand. That is roughly the entire annual production of the Lucky Friday mine, times 5. This is a bidding war. It is Samsung versus Tesla versus BYD. And the prize is the microscopic amount of silver dust available on planet Earth. Now the skeptics, the guys at Goldman Sachs who are short silver, will tell you, don't worry about the mine supply. We will just recycle the silver from old batteries. This is the recycling myth. And it is logically bankrupt. Here is why. The Samsung solid-state battery has a warranted lifespan of 20 years. If you buy a Samsung-powered BMW in 2027, that car stays on the road until 2047. The 1 kilogram of silver inside that battery is locked away for 2 decades. It cannot be recycled because it is still being used. This is what we call a stock flow trap. In the short term, the next 15 years, the flow of silver is one way into the car. Zero comes out. We won't see any significant recycling supply from these batteries until the mid-2040s. But the demand is happening now. So where does the metal come from today? It has to come from the mines. Or it has to come from your stack. This is why the price has to go vertical. The market has to incentivize you to melt down your silverware. It has to incentivize you to sell your Eagles, because the secondary supply from cars is zero for the next generation. Another argument we hear: they will just thrift it out. They will use copper instead. This is the solar panel argument. In solar, they did reduce the amount of silver per panel. They went from 500 milliliters to 80 milliliters. They got efficient. But a battery is not a solar panel. In a solid-state battery, the silver isn't just a conductor. It is a structural host. The silver carbon layer is what physically holds the lithium ions in place. If you remove the silver, the lithium forms dendrites, spikes, and the battery explodes. Copper doesn't work. It reacts with the electrolyte. Aluminum doesn't work. It expands too much. Only silver works. Physics does not negotiate. You cannot thrift the silver out of this chemistry without sacrificing the 9-minute charge time. And since the 9-minute charge time is the entire selling point of the car, they won't cut it. The thrifting wall has been hit. Samsung needs the full 5-micron layer. That means the 1 kilogram per car figure is sticky. It isn't going down. We have to talk about the data that is being suppressed. The Silver Institute is the official body that tracks supply and demand. For years, they have been criticized for underreporting demand. They often ignore military use and clandestine inventory builds. But we have received information about their upcoming 2026 interim report. They are preparing to make a massive revision. In 2024, they pegged total demand at roughly 2 billion ounces. The leak suggests that for 2026, they are adjusting that number to 5 billion ounces. Why the 300 million ounce jump? The footnotes allegedly cite unanticipated acceleration in automotive sector offtake and solid-state pilot programs. Think about that. They are admitting, behind closed doors, that demand is jumping by 25% in a single year. We are already in a deficit of 200 million ounces. If demand jumps another 300 million, the deficit becomes 500 million ounces per year. We only mine 850 million. If the deficit is 500 million, that means we are consuming 60% more silver than we mine. Where does the extra 500 million ounces come from? The vaults are empty. The registered inventory is 30 million. The eligible inventory is frozen. This is a mathematical impossibility. And when a market hits a mathematical impossibility, the price reprices. It doesn't go up 10%, it goes up 10x. Let's look at this from the perspective of the CEO of BMW. You are building a $120,000 luxury super sedan, the i7 solid state edition. So it needs 1 kilogram of silver. Right now, Silver is roughly $70. So the silver cost is $2,250. That is 8% of the car's price. Negligible. Now, imagine silver goes to $200 an ounce. The silver cost becomes $6,400. That is 3% of the car's price. Does BMW cancel the car? No. They just raised the price of the car to $126,000. The customer buying a six-figure car doesn't care about an extra $6 for a 9-minute charge time. They will pay it. This is called inelastic demand. The industrial user must have the metal to build the product. The price of the metal is a small fraction of the final product cost, so they will pay any price. Compare that to you. If silver goes to $200, are you going to run out and buy a monster box for $100,000? Probably not. You might sell. But Samsung will buy. BMW will buy. Tesla will buy. They have the capacity to absorb $200 silver or even $500 silver. They will simply pass the cost to the consumer. This is why the price cap is gone. There is no logical reason why silver stops at $50 or $100. The pain point for the auto industry is likely closer to $1,000 an ounce. At $1,000 an ounce, the silver costs $32,000 per car. That is when they stop. But between $70 and $1,000, it is open road. If the Samsung battery was the only story, silver would be going to $100. If the industrial shortage was the only story, silver would be going to $150. But there is a third pillar to this crisis, and it is the one that turns a shortage into an extinction event. War. While we were analyzing battery chemistry in Part 1 and Part 2, a different kind of signal started flashing in Washington, D.C. It is an indicator that has predicted the Gulf War, the invasion of Panama, and the start of the Ukraine conflict. It isn't a stock chart. It isn't a satellite image. It is a pizza box. For those who don't know, the Pentagon Pizza Index is a real phenomenon. When the Pentagon is planning a major operation, when the generals are staying up all night in the Situation Room, they get hungry. They order pizza. Local delivery drivers in Arlington, Virginia have reported spikes in orders right before every major conflict of the last 30 years. Yesterday, December 22nd, at 11 p.m. EST. The index didn't just spike, it broke the chart. We have reports of delivery drivers being turned away at security checkpoints because the volume was too high. The lights at the Pentagon were on all night. Why? What are they preparing for? They are preparing for the news that just broke on the AP wire this morning. Russia is evacuating the families of its diplomats from Venezuela. This is not a drill. When a superpower pulls its civilians out of a proxy state, it means kinetic action is imminent. It means the Cold War in South America is about to turn hot. And you have to ask yourself, why does a silver investor care about Venezuela? Venezuela doesn't produce much silver, but its neighbors do. Venezuela shares a border with the destabilized region that feeds into Peru and Chile. If Venezuela becomes a theater of war, if the U.S. Navy blockades the Caribbean, the supply lines from South America are cut. Peru is the world's third largest silver producer. Chile is a massive copper-silver producer. If those shipping lanes are compromised, if the Panama Canal is restricted, Panasonic, Tesla, and Samsung cannot get their silver. The Pentagon Pizza Index is telling us that the supply chain isn't just empty, it is about to be severed. This brings us to the most terrifying competitor for silver. It's not Samsung. It's not Tesla. It is Raytheon. We talked about how a Samsung car needs 1 kilogram, 32 ounces of silver. Do you know what else needs silver? The Tomahawk cruise missile. Estimates from defense contractors suggest that the guidance system, the contacts, and the high-performance batteries inside a single Tomahawk missile consume roughly 500 ounces, 15 kilograms, of silver. Why? Because when you're flying a missile at 500 miles per hour into a bunker, you cannot afford a connection error. You need the most conductive metal on Earth. You need silver. You don't use copper in a kill chain. You use silver. Here's the problem. In 2024 and 2025, the U.S. military depleted its stockpiles. We fired missiles in the Red Sea. We shipped missiles to Ukraine. We shipped missiles to Taiwan. The inventory is low. Now, with a Venezuela signal flashing, the Pentagon needs to restock. They need to build thousands of new missiles. Thousands of missiles, x 500 ounces per missile, or millions of ounces of strategic demand. So now you have a three-way war for the metal. Samsung wants it for cars, consumer. The Pentagon wants it for war, strategic. You want it for wealth preservation, monetary. Who wins? The Pentagon wins. They have the Defense Production Act. They can seize inventory. They can force mines to sell to them first. But here is the catch. The U.S. doesn't have enough mines. We rely on imports. We rely on Mexico. And Mexico is no longer our friend. Mexico is the Saudi Arabia of silver. They are the number one producer in the world. For decades, they simply dug it up and shipped it to U.S. refiners. It was automatic. But the political winds have shifted. We are seeing a rise in resource nationalism across Latin America. Mexico has already nationalized its lithium. There are bills in the Mexican Congress right now proposing the nationalization of strategic metals, including silver. Why would they do this? Because they see the price going to $150. Why would they let a Canadian or American mining company extract their wealth for pennies just to sell it to Samsung? The Mexican government is looking at the Samsung battery tech and thinking, wait a minute, if every car needs 1 kilo of our dirt, maybe we should build the cars here. Maybe we should keep the silver. If Mexico declares an export ban, similar to what Indonesia did with nickel or what China did with gallium, the U.S. supply chain collapses overnight. Samsung cannot build its batteries without Mexican silver. Panasonic cannot build its batteries without Peruvian silver. We are one executive order away from a complete blockade of North American silver supply. And with the geopolitical tension rising in Venezuela, the odds of a Latin American resource alliance against the West are higher than ever. Let's look at this from Samsung's perspective. They are based in South Korea. They have virtually zero domestic silver mines. They import 99% of their raw materials. To build the 9-minute charge battery, they need silver from Mexico and Peru to travel across the Pacific Ocean to reach their factories in Seoul and Ulsan. What happens if the Pacific becomes a no-go zone, with China surrounding Taiwan, with Russia active in the Pacific? Shipping insurance rates are already skyrocketing. If a blockade happens, or even just a disruption in shipping lanes, Samsung's factories starve. They have just-in-time inventory. They don't have a year's worth of silver in a vault. They have maybe 2 weeks. This vulnerability is why Samsung is panic buying now. They're trying to front-run the war. They're trying to get the physical metal onto Korean soil before the missiles start flying. This explains the premium we are seeing in Asia. It explains why silver is $74 in Shanghai and Seoul, while it is $68 in New York. The Asians are pricing in the war risk. The Americans are still pricing in the Fed pivot. One of these markets is awake. The other is asleep at the wheel. So let's combine these factors. Tech demand? Samsung needs 1 kilo per car. War demand? The Pentagon needs 500 OZ per missile. Geopolitical blockade. Russia, Venezuela, Mexico threatening supply lines. This creates a scenario that commodity traders call unobtainium. It means that at any price, you cannot get the metal. If you are Samsung and you have a factory with 10,000 workers waiting to build batteries, and the silver shipment doesn't arrive, you lose billions. So what do? You go to the private market. You call Glencore. You call Trafigura. You call the private vaults in Zurich. And you say, I don't care what the COMEX price is. I don't care if it's $68. I will pay you $150 right now. Put it on a plane. This is the dark market. It is happening right now. While you watch the ticker tape, the real deals are happening off exchange. Samsung is securing supply at 100 plus. Tesla is securing supply at 100 plus. Raytheon is securing supply via government decree. The only people left looking at the $68 price are the retail investors who are about to be rug pulled. History rhymes. In World War II, silver was so critical to the Manhattan Project for the uranium enrichment magnates that the US government took 14,000 tons of silver from the treasury. They didn't pay for it, they just took it. Because without silver, you lose the war. We are entering a period where silver is no longer just money, no longer just industrial. It is strategic. It is the difference between having a working missile guidance system and a dud. It is the difference between energy independence, EVs, a solar, and oil dependence. The governments of the world know this. China has been hoarding silver for this exact moment. Russia has been hoarding. The US? We sold our strategic stockpile decades ago. We have zero. We are naked. And now, with the war drums beating in Venezuela and the Pacific, I think the US government is realizing it made a fatal mistake. Expect them to enter the market. And when the US government enters the market to buy a strategic asset, they don't care about the price. They print the money to buy it. This is the ultimate whale entering the pool. We have talked about Samsung. We have talked about the Pentagon. But right now, we need to talk about you. Because while the big boys are fighting over 1,000-ounce bars in London, you are trying to buy 1-ounce coins in Nebraska or Texas or Manchester. And you are realizing that something is very, very wrong. We have been getting emails all morning. My order was canceled. The premium on Eagles just hit 60%. My dealer isn't answering the phone. Why is this happening? If silver is $68 on the screen, why can't you buy it for $75? Why is the price unavailable? We just got off the phone with a major U.S. wholesaler, one of the big three that supplies the local coin shops. He agreed to speak to us on the condition of anonymity. And what he told us reveals the dirty little secret of the retail bullion market. The dealers aren't just sold out of metal. They are bankrupt on paper. Most people think a coin dealer works like a grocery store. They buy low, sell high. That's not how it works. The margins on silver are razor thin, maybe 1% or 2%. If the price of silver drops $2 or $0 while the inventory is sitting on the shelf, the dealer goes broke. So how do they survive? They hedge. When a major dealer buys 100,000 ounces of silver from the mint, they immediately turn around and short 20 contracts on the COMEX. This locks in the price. If silver goes down, their inventory loses value, but their short position makes money. They are market neutral. It is the only way to run a low-margin business safely. But do you remember what happened at 3:01 a.m. this morning? The margin hike. The CME Group doubled the margin requirement for shorts. Suddenly, every dealer in America who was hedging their inventory got a margin call. They had to wire millions of dollars in cash to the exchange to keep their hedges open. They didn't have the cash, so the exchange liquidated their hedges. Now, you have dealers sitting on millions of dollars of physical inventory, completely unhedged. If the price drops 5 in your wars, they are insolvent. But if they sell the metal to you, they can't replace it because the wholesalers have cut them off. They are paralyzed. That is why they turned off the buy buttons. That is why they stopped answering the phones. They are frozen in a financial no man's land, terrified to sell an ounce because they don't know if they can ever get it back. The sold out signs aren't just about supply. They are about counterparty risk. The entire retail supply chain is broken because the paper hedging mechanism just blew up. If you can't buy physical, you might be tempted to buy SLV. It tracks the price. It's liquid. It's easy. Stop. If you own SLV right now, you are sitting in the blast radius of a thermonuclear bomb. You need to understand the difference between authorized participants and you. SLV holds silver in a vault, yes, but you do not own that silver. You own a trust unit. Here is the nightmare scenario detailed in the prospectus. When the market breaks, like it is doing right now, the authorized participants, JP Morgan, Citi, HSBC, are the only ones allowed to withdraw physical metal from the trust. So JP Morgan sees the shortage. They see the Samsung demand. They go to the SLV vault. They redeem their baskets of shares. They load 50 million ounces onto a truck and drive it to their private vault. What is left in the SLV vault? Paper, promissory notes, unallocated claims. And then the trust declares force majeure. They invoke the clause that says if physical delivery is not practicable, the trustee may settle in cash. Here's how the theft happens. Silver is trading at $150 on the street, the real price. The COMEX is frozen at $75, the fake price. SLV declares force majeure. They liquidate the fund and send you a check based on the $75 price. You get your dollars back, but you wanted silver. You go to buy silver with your $75 check, and the dealer laughs at you. Silver is $150, buddy. You just lost 50% of your purchasing power instantly. The authorized participants, the banks, stole the metal. You got the depreciating fiat. This is legal. It is in the contract you didn't read. A graphic showing a bank balance sheet. Unallocated silver is listed under liabilities. It gets worse if you hold an unallocated account at a bank or a digital platform. Many of you think, I bought digital silver. It's in the vault in London. If you do not have a serial number for your specific bars, you do not own silver. You are an unsecured creditor of the bank. In a normal bankruptcy, you stand in line. But in a systemic failure, which is what a $200 silver squeeze triggers, the rules change. We enter the realm of bail-ins. Remember Cyprus in 2013? The banks failed. The government didn't bail them out. They bailed them in. They took the depositors' money to recapitalize the bank. If you hold unallocated silver, you are a depositor. The bank will take your silver, sell it to Samsung to pay their debts, and give you bank equity tokens or some other worthless paper. You will log into your account, you will see 0 ounces of silver, and you will see 1,000 shares of bankrupt Bank Corp. This is why we scream, if you don't hold it, you don't own it. In 2026, counterparty risk is the only risk that matters. If there is a counterparty between you and your wealth, that counterparty is going to steal it to save themselves. Now, let's look at the psychology, because this is the most confusing part for new investors. We just saw a report from a major online dealer, SilverTrade, who posted incredible data this morning. He said, we are seeing 20 times more sellers than buyers. Wait, Samsung needs 1 Nihilus per car. The Pentagon is panic buying. China is paying a premium. And the retail public is selling. Why? Because they are tired. They are annoyed. They bought at $30. They watched it go sideways. They watched the volatility. They listened to the mainstream media telling them it's a bubble. And now, seeing $68, they think, finally, I can get out with a profit. I can buy that boat. I can pay off that credit card. This is the weak hands capitulation. This is exactly what the banks want. They need the public to sell. Where do you think JP Morgan is getting the metal to ship to China? They are buying it from you. Every time a retail investor sells an eagle for $70, a refiner melts it down, turns it into a 1,000-ounce bar, and ships it to Samsung. The wealth is transferring from the little guy to the industrial giant. Historically, when the public sells 20 to 1, that is the ultimate bottom. That is the moment the rocket leaves the launch pad. Because once the retail supply is gone, there's no one left to sell. The buffer is gone. Hansa Czerny called it attrition. Ounce by ounce, day by day. The public is handing over their generational wealth to the elite for pennies on the dollar. We need to discuss the term force majeure. You're going to hear this phrase a lot in the next 48 hours. It is a French legal term. It means superior force. It is used in contracts to excuse a company from delivering on its promises due to acts of God, hurricanes, earthquakes, war. But the miners are preparing to use it for commercial impracticability. We have seen draft letters from Mexican miners preparing to declare force majeure on their U.S. contracts. Their argument? The geopolitical instability in Venezuela and the regulatory changes in Mexico make it impossible for us to export silver. Once a miner declares force majeure, the supply chain stops instantly. The refiner stops. The mint stops. The dealer stops. And SLV declares force majeure on you. This is the domino effect. And the first domino, the Russia-Venezuela evacuation, just tipped over. When force majeure is declared, the price of silver becomes theoretical. It doesn't matter if the screen says $70 or $700, you cannot buy it. The market becomes bid only. Millions of buyers, zero sellers. That is the definition of unobtainium. We have spent the last hour documenting the crime. We showed you the margin hike, the Samsung leak, the Pentagon Pizza Index, the dealer default. If you have watched this far, you are likely feeling two things. Anger, because the system is rigged. Fear, because you realize the doors to the physical market are closing. You're asking, if the dealers are sold out, if SLV is a trap, if the premiums are 50%, how do I participate? How do I protect my family? The answer lies in the ground. If you cannot buy the metal above ground, you must own the metal below ground. You must own the miners. While the manipulation has suppressed the spot price to $68, the mining stocks are the last free market left. And right now, they are flashing the biggest buy signal in history. Here's the anomaly. Silver is up 140% YTD, but many mining stocks are only up 80% or 100%. Why? Because Wall Street hates miners. They think mining is dirty, risky, and capital intensive. They are still pricing these companies as if silver is $30. But here's the math they're missing. If a miner's cost to pull silver out of the ground is $20 an ounce, at $30 silver, they make $10 profit. At $70 silver, they make $50 profit. The price of silver went up 3x, but the miner's profit went up 5x. This is called operational leverage. And if silver goes to $100, that miner's profit goes to $80. That is an 8x increase in cash flow. In 2026, the mining companies will be the most profitable companies on the S&P 500. They will print more cash than Apple. And because they are the only source of new metal for Samsung and Tesla. They hold the keys to the kingdom. If you're scared of mining risks, if you're scared of a mine collapsing or a government nationalizing it, there is a safer way. The royalty companies. Look at Wheaton Precious Metals, WPM. They don't dig holes. They don't drive trucks. They don't deal with unions. They simply provide cash to miners up front in exchange for the right to buy silver at a fixed price forever. Wheaton has contracts that let them buy silver for roughly $4, $4 to $6. Om die Zurs are an ounce. Forever. Imagine buying silver for $6 when the market price is $68. That is what they do every single day. They are a cash printing machine. And because they don't have operating costs, fuel, labor, electricity, they are immune to inflation. If you can't find physical coins, buying WPM stock is like buying a stream of silver that never ends. It is the safe haven of the equity market. But if you want maximum leverage, if you want to turn $10,000 into $100,000, you look at the primary miners, the ones with the most reserves in the ground. We track the data. First Majestic Silver, AG. This is the purest play. They hoard their own silver. They refuse to sell it cheap. They even run their own bullion store, which, by the way, is currently sold out. Their stock acts like a call option on silver. If silver goes to $100, First Majestic could go to $100. Hecla Mining, HL. They operate the Lucky Friday mine in Idaho. one of the few massive silver mines in the United States. Why does that matter? Strategic security. If Mexico bans exports, if Peru gets blockaded, Hecla is inside the U.S. borders. The Pentagon will protect them. The U.S. government will buy every ounce they produce. They are the national security play. Owning these stocks isn't just an investment. It is a claim on the future supply that Samsung desperately needs. So where does this end? What is the number? We told you $70 was the start. We told you $100 was the bank breaker. But now, with the Samsung 1Q data, we have to revise our target higher. If every EV needs 1 ICO of silver, and if the EV manufacturers have inelastic demand, meaning they will pay anything, the price of silver must rise to the level where it forces everyone else to stop buying. At $100, does the solar industry stop? No. They need it too. At $120, does the investor stop? No. The FOMO kicks in. The price has to go high enough to force recycling and disinvestment from jewelry. We estimate that pain point is roughly $150 to $200. At $150 an ounce, you will see people selling their grandmother's tea sets. At $150 an ounce, you will see massive recycling efforts begin. That is the price required to balance the Samsung deficit. So, my official target for 2026 is $150. Zuros. That is a 2x from here. But remember, in 1980, silver went up 5x in 2 months. When it moves, it teleports. I want to speak directly to the people who have been with us since $20, to the people who stacked when everyone laughed at them, to the people who held when the price was smashed. You were right. They told you it was a pet rock. They told you it was a barbarous relic. They told you crypto was the only future. But today, on December 23rd, 2025, looking at the empty vaults, the desperate banks, and the desperation of the industrial giants, we know the truth. Silver is not just money. It is technology. It is energy. It is freedom. The wealth transfer we talked about for years. It isn't coming. It is here. The banks cheated last night because they lost. They changed the rules because they lost. They broke the market because they lost. You won. You hold the asset that they need. You hold the collateral of the new world. So do not sell. Do not let them shake you out at $68. Do not let them steal your victory. Hold the line. Watch the miners and watch the Samsung rollout. Because the era of paper manipulation is over. The era of price discovery has begun. I'm John. We at Currency Archive want to thank you for being part of this movement. Remember to like and subscribe, and if this message resonated with you, share it. Wake up your family, wake up your friends. We are building a lifeboat, and there is still room, but the tide is rising fast. Stay safe, stay stacked, and we will see you on the other side of the reset.